Do you want to change your life with Forex trading? Do you want Forex trading to pay your bills? In this video, I'm going to give you a step-by-step guide on how to kickstart your trading journey so that you will become a millionaire trader before 2025 runs out. So the first thing we're going to do now is to create your trading account. So for you to create your trading account, you need a broker. And I'm going to recommend one, which is the broker I use, Opta. The link is in the description. So once you click the link, it will take you to your Play Store or your App Store where you will download the Opta Trading app. So once you download the Opta Trading app, you sign up. Once you click on sign up, it will take you to the page where you can either sign up with your Google account or your Facebook or even your email. Then after that, you create account by clicking on create account, and then you choose your trading platform. So you can use the Opta Trader because Opta, which is my broker, has a trading platform where you can also place your trades. So the app is all encompassing. You can do your analysis there. You can execute your trades there. Just everything inside one app. So you can choose the Opta Trader. You can also see the other options there. And then you can put in your leverage, which is 1:1000, or you can also check others to pick the one of your choice, or you can just use 1:1000. Then after that, you click on create trading account. After that, you go ahead and make your deposits. So click on deposit. It will bring you to this page where you will pick your payment methods. Here you can just use your instant bank transfer. So click on it. After that, you type in the amount you want to deposit and click next step. It will bring you to where you will choose your bank. So you quickly select your bank and go ahead and finish your payment. You can also use my promo code happiness. Just type it in here. You can see enter promo code. You type it in here and then activate to double your deposit. Then after that, you finish up your deposit and your account is ready. So it's that simple. Your trading account is ready. Now, this is one thing you need to know about trading. If you're coming in to trade, you need to understand that it's not a get-rich-quick scheme. You need to have it in mind that in trading, your capital is at risk. The money you've deposited, your trading account is at risk. So what makes you a good trader is that you need to manage the losses and also manage the profit. So make sure that the profit outweighs the loss, because if it's for losses, it will happen. But what makes you a good trader is making sure that the profit outweighs the loss, because the reality of trading is you accepting both sides. So don't come in thinking there is money somewhere that you need to pack and leave. It's not done that way. So you need to be ready. You need to have a trader's mindset. You need to be ready to risk something to get something, because at the end of the day, we are all speculators. So we are going to quickly go to the chart so that I will explain what we actually do to make money as traders. So we're going to start with currency pairs. When trading Forex, you are literally speculating two currencies. You are buying and selling two currencies, and thus the currency pairs. So there are also other branches of trading, but we are just going to focus on Forex trading. So like I stated earlier, if you're trading Forex, what you're going to focus on is speculating two currencies, whether one will buy or the other will sell. So for instance, let me open the chart. Now we're looking at USD JPY chart. That simply means we're looking at two currencies, which is US dollar and Japanese yen. So we are speculating whether the US dollar is going to push up or down. In a situation where we speculate that US dollar will push up, that simply means at the same time, we are speculating that Japanese yen will push down. So any chart you are looking at, just have it in mind that the first currency is the base currency, while the second one is the quote currency. So what you can see here, they are called candlesticks. And then the blue one simply shows when US dollar is doing well, while the black one simply shows when Japanese yen is doing well. Same thing is applicable if you open another currency chart. So now this one is GBP USD. GBP USD, GBP here is the base currency, US dollar here is the quote currency. So the blue candlestick shows that GBP is doing well more than the currency that is paired to it, which is USD. That's just how you can understand this chart. And how do we look at this chart, all these things, all these candlesticks? How do we look at this and make money? From these two currencies we are looking at, all you just need to do is get a strategy, which I'm going to teach you. So make sure you watch to the very end and subscribe, turn on the notification bell so that you always be notified whenever I drop educational videos here. So let's continue. Once you get your strategy, you will use your strategy to know when to actually speculate whether the base currency is going to push up against the quote currency, or whether the quote currency is going to do better against the base currency. That is just it. So have in mind that any chart that you open, the first currency is the base, while the second is the quote. So just like I have it here, I've already customized my chart with my own favorite colors, which is white, blue, and black. If you download your own trading app, you will get the default color, which is red and black. So you can actually go ahead and customize it to your own, or you can work with the default color. So that is it. When looking at this chart, the blue candlestick represents the base currency. That is the first currency that will always be stated here. So if we are speculating that pounds should push up, you can see this long push up. Let's say you speculated that pounds should push up and it pushes up like this, you are going to make money. And then if you speculate that, okay, dollar should increase in price more than the pound, that simply means the black candlesticks will start showing up and it will be pushing down because it's the quote currency. So that is just how we do it. So remember what I said, if you're trading Forex, you are literally buying and selling two currencies at the same time. Still on the basics of trading, if you look at this section, we have different time frame here. So if we are looking at the monthly time frame, that simply shows that everything that's happened here, happened in 1 month, which is each candlestick, that is one candlestick here. This is the month of January 2025. If we take it back, this is the month of December, which is last year 2024. So when you're looking at the monthly time frame, each candlestick represents what has happened within 1 month. If you're looking at the weekly time frame, each candlestick represents what has happened within 1 week. So something is applicable with the daily, 4 hours, all the way down to 15 minutes or lower time frames. So when it comes to time frame usage, it depends on the type of trader you are. We have the position traders. Now, if we're talking about position traders are traders that can take a position and they can be able to hold it for months, even for years and years. Then we have swing traders. They are traders that can, hold their trades for weeks, months, and maybe approximately just week and months. And then we have the day traders. The day traders are the ones that can hold their trades, can open a trade in a day and decide to close it same day, or you can hold it for 2 days, highest 1 week or 2 weeks. Then we have the scalpers. Personally, I call those ones the hit and run traders. So they focus more on the lower time frame, like the 1 minute time frame. So they just take advantage of the, few seconds movements and leave the market. So they don't have time to waste in the market. Then if you're a day trader, then you should be looking to catch your entries from 15 minutes, 30 minutes, highest 1 hour. Because if you start picking entries from 2 hours, 4 hours, it may be a swinging entry. So that's just the importance of this time frame. And we also have trade sections. So we have three main trade sections. We have the London section. If you're in Nigeria, the London section starts from 8 a.m. and it will close 1 p.m. Then we have the New York section, which opens 1 p.m. to 10 p.m. in the night. Then we have the Asian section, which can open from 10 p.m. Inside the Asian section, we have the Sydney and the Tokyo, but putting them together, they are generally called the Asian section. So it opens from 10 p.m. throughout the night to close 8 a.m. and it will come back again to London, just like that. So these are the trade sections. So, but if you want to catch the movements in the market, if you want to get big spikes like this one we are seeing on this chart now, if you want to get big spikes, then you should focus on trading during London and New York section. That is when a lot of pairs will be very volatile. But then if you're trading during Asian section, you can still be able to catch good trades during that time, but just having in mind that market will be very slow. So that is it for trade sections. Now I'm going to go ahead and teach you what you should know. This one is very important because even when you become an advanced trader, you need to still be using it. You need to understand it, which is the peep and lot sizing, because that is what will make your account grow or your account go back to zero. So have that in mind. You need to be very conversant with the lot size you are using to trade and also know how to calculate your peep. So when it comes to peep calculation, let's speak it one after the other. When it comes to peep calculation, this is very important because it shows us how the market is moving. Because if you check this candlestick now, we have a movement ongoing. Now the question is, how do you know how many moves the market has dished out? That is what we call peep calculation. That is percentage in point. So for currencies without JPY on them, that is currencies without, what am I writing? Currencies without JPY. You start your peep calculation from the fourth number, that is the fourth number after the decimal point. Fourth number after the decimal point. After the decimal point. Then we have currencies with JPY on them, or let's just call it pairs with JPY. That's the JPY pairs with JPY. To calculate your peep, you start from the second number after the decimal point. After the decimal point. So that's how to calculate this two currencies. So currently we are looking at currency without JPY on it, which is GBP USD. If you look at this section, you will notice that we have different coordinates here, and this one is moving. So this shows the current market price. That is what I'm going to type out. So we have 1.22962. So this is the current market price. And if you check, I said currencies without JPY, the peep calculation starts from the fourth number after the decimal point. So if you check from here, you can see after the decimal point, we have 1, 2, 3, 4, 5 numbers after the decimal point. So what you just need to do, the number at the last point, which is these two, you will take it out because it's not that important if you are trying to calculate pip. It's called the pipette. So you just need to focus on the fourth numbers. That's the four numbers after the decimal point. You take away the last number. So from here now, since we have 1.2296, if the market should move from 1.2296, let's say, to 1.2297, that simply means it has dished out one pip movement. That is how currencies without JPY moves. It has dished out one pip movement. Same thing is applicable if you should move from 1.2298. That simply means it has dished out 2 pips. Just like that. Now let's quickly go to currencies with JPY. Let's look at USD JPY. Let's take this out. So let's look at USD JPY. Now, if you check on USD JPY, you will notice the current market price, which is 155.630. So same thing is applicable to this one too, because we are starting our pip calculation from the second number after the decimal point. So we'll take away the last number, which is 0, and work with the first two numbers after the decimal point. So if the market should move from 155.63 to, let's say it moves from 155.63 to 155.66, let's just leave it at 6. That simply means market has moved 3 pips. So that is how it moves. Very simple. And now, from this chart we are looking at, you obviously have tools you can use to calculate your pips. What I just did now is the manual aspect, but when the market is moving and you want to start taking trades immediately, you may not want to go into the manual calculation of pips. So you can just pick up your tools. If you check here, we have the measuring tool here. We have the measuring tool. But normally, what I use is the position tool. If you click here, you see the position tool. We have the long position, the short position. So if you are speculating that the market should push up, then you need to work with your long position. Let's say you want to sell from this particular level now. What I mean by sell is that you are speculating for USD to do better than British pound here now. So what you will use, you pick your short position tool and place it. Then from your strategy, you will know where to place your SL and take profit. So like I said, make sure you watch to the very end, because I'll be showing you a strategy that you can use to actually know when to buy and sell and make money, because that is the main point in trading. Not even all this theory I'm putting out here. The main point is for you to get a strategy that you can use to actually milk the market and make money. So make sure you watch to the very end. So let's say from your strategy, your stop loss is meant to be here and your take profit here. So when we are talking about stop loss, remember I said trading, you need to be ready for both sides. You need to be ready for the loss and the profit. So as a trader, what makes you a successful one is to make sure that your profit outweighs the losses. So whenever you are trading, you are planning to lose something or to gain something. So something must be sacrificed to gain more. So what you are sacrificing is actually your stop loss. So you need to, from your capital, you need to have a certain percent you are willing to, risk. So that's your stop loss. And then from your speculation, you want the market to drop to this point. So any point you want the market to drop and get to, that is your take profit. And once market gets to either your stop loss or your take profit, the trade will close automatically. If it goes according to your speculation, you're going to make good money. Then if it goes against you, you're going to lose what you're actually willing to sacrifice. So that is it. So using this tool to know your PIP calculation, if you check from where I placed this tool, that is from the entry price, this tiny line demarcating the profit zone and the loss zone is actually the entry price. And if you trace it down here, you will see the coordinates, which is 1.22906. Now from the entry price to where the stop loss zone is, it has been calculated. If you check at the center, it has been calculated that it is 20 pips. So you don't need to come and start doing the manual aspects of adding, plus and minus and the rest. Just need to work with your tools. So from here, it has showed that the stop loss is 20 pips away. And then from the entry price to your profit zone, if you check the number at the center, it shows that your take profit is 102 pips away. So this is kind of, if you check here, risk to reward ratio is 4.93, which simply means that this is 1:4 risk to reward ratio. You are risking 1% to catch 4%. That simply means since you are risking 20 pips, you are about to catch 20 pips times 4. That is 1:4 risk to reward ratio. So whatever you are risking, if the price should go to your take profit, you are going to make times 4 of whatever you are risking. So that is the importance of risk to reward ratio. And that's why I said you should pay attention to what I'm teaching you here, because you're not just learning it as a beginner. It will help you in the long run. Even when you become an advanced trader, it will help you understand how to manage your risk well and make good money. Because remember, to become a successful trader, your profit should outweigh the loss. And how can you be able to achieve that? You need to understand your risk management strategy. And this is it. So that is how you get to calculate your PIP. Same thing is applicable with pairs with JPY. Just use your tools. If you want to sell, you use the short position tool. If you want to buy, you use the long position tool, just like this. So it's that simple. So let's look at lot sizing or lot size. This moves hand in hand with your PIP calculation, because if you get to understand your number of pips, you also use that to know the lot size to use when trading. But before we go into that calculation, let's get to understand what lot size means. This will help you determine what you are going to make whenever you are taking trades and what you're going to lose. And then we have 3 classes. We have the micro lot size, we have the micro lot, we have the mini lot, we have the mini lot, and we have the standard lot. We have the standard lot. So your account size will determine the class you will be picking your lot size from. So when it comes to the micro lots, for the micro lots, it ranges from 0.01 to 0.09. So which simply means if you are picking lot size from this particular group, you'll be trading in cents. So this 0.01, if you're trading with 0.01, that simply means you are risking 10 cents per pip movement. So as it ranges from 0.01 to 0.09, that is 10 cents to 90 cents. 0.90, that is 90 cents. 90 cents. And then we have the mini lot size. For the mini lot size, it ranges from 0.1 to 0.9, which simply means if you are trading from this class, you are risking $1 to $9 per pip. That is $1 to $9 per pip. And then for the standard lot size, it ranges from 1 lot to what your account can take. So I'm just going to put it as unlimited. Unlimited. So that simply means it can range from, if you are trading with 1 lot, you are risking from $10 per pip up. So that is it. Now, that was why I said when you are picking your lot sizing, you need to understand your account size, because if you're trading an account, let's say from $10 to $200, you should focus more on the micro lot size. You should focus more on the micro lot size. Then if you're trading from $300 to $1,000, then you should focus more on the mini lot size. Then from $2,000 up, you should be picking your lot size from standard lot. That is if you want to take, a minimal risk, just a medium risk on it. But if you want to go aggressive, it all depends on you and your account. It's your capital. So you decide what is, a risk management for you, how to manage your risk and then take your trades. So, like I said, the number of pips for your stop loss will determine the lot size you're going to use. But I just broke it down now, based on account size. If you're trading from $10 to $200, focus more on the micro lots. From $300 to $1,000, should be picking from the mini lots. Then from $1,000 or from $2,000 up, focus more on the standard lot. So that is it on lot size. So now we are going to go into how you can actually make money as a trader, how to speculate, how to know the next line of action, from the chart. So the first thing is for you to understand where the market is directed at, and that is called market structure. So let me hide this and explain what I mean by that. That is called the market structure. And when it comes to market structure, there are 3 types. So when the market is moving like this, creating new highs, this simply means that the market is directed to the upside, which is called bullish trend. Let me write it out. Bullish trend. And then when the market is moving like this, creating more lows, higher lows, lower low, higher lows, just like that, it is called bearish trend. It is called bearish trend. And then we also have when the market is giving a sideways movement, when it's giving equal highs and equal lows, just like this. Now this is called a ranging market, or you can just call it sideways movement. Sideways movement. So these are the 3 types of market structure. Now, what I'm going to teach you is for you to focus more on the bullish trend and the bearish trend. So that means whenever the market is giving this type of movement, sideways movement, you need to actually wait for a breakout. You need to wait for market to give you a direction, whether to the upside or to the downside. Because whenever it is giving this sideways movement, just as the name implies, there is no direction. So if you are trying to speculate for the currency that is behaving like this to push up or down, you may be taking, although trading is risky, but the risk may not be well calculated. You may be risking your account to the extent that most of your trades may just be hitting your stop loss. You will be losing much money. So you need to wait until the market gives you a direction, because the trend is your friend. So if the market is behaving this way, breaking structures, moving to the upside, dishing out new highs, which simply means it's bullish, that simply means on that currency you should be looking to buy, to speculate more that the currency will keep pushing up. Now, same thing is applicable with this type of movement. If the market is pointing to the downside, which simply means a bearish trend, that means you should be looking to sell or stay away from sideways movement. So we're going to open the chart now. Let me clear this. We're going to open the chart now and check the direction. We're just going to use this one as an example. Then after watching this video, you can go ahead and do your own practice. I'm going to leave my number in the description. So all you just need to do, you can message me there to ask your questions after watching this video. So we're going to use this chart now to know the direction the market is going. So if I want to know the direction, first I will go to the daily time frame. Remember what I said about time frame. So when we're looking at daily time frame simply means everything that is happening here. Each candlestick represents what has happened within one day. That's just how to explain it simply. So if you check from here to here, this is the current candlestick that is moving. So if you check the trend, this is looking like the example that I just gave on bearish trend. You can see price is dropping to the downside, which simply means that this is on a bearish trend. But you don't just draw this line like this to just be sure that the market is on a bearish trend. You need to learn how to read your market structures, which I will show you here. And you can also check my channel. You will see where I specifically explained how to read market structure. The video will help you too. So looking at what we have here, if we are trying to read the market structure from here, you can see this is a key level, and you can see how market cleared it to the upside, which is what I call break of structure. Now, as market cleared it to the upside, we have another key level here. Now, why is this a key level? It's expected that price should come here, react, and give us another push if the market is still bullish, because from here it was giving new highs. That is a bullish trend before it changed. So what do we call this? As market came to this level and cleared this key level, because from here we got the push that cleared this high here, which caused a break of structure. So this is literally the origin that caused a break of structure. And following our strategy, once we get a break of structure, the origin that causes the break of structure, will be expecting market to come inside that origin, and then we'll buy again. So if we get a break, we want market to come back into that origin, then we'll keep buying. But now price came back into that origin and cleared it to the downside, which now gave us a change of character. Just as the name implies, it simply means that the market has changed character from creating new highs to creating new lows. So it has given us a change of character. That simply means if you were buying when the market was creating new highs, from now you should be looking to sell. That is what this means. So this is a change of character. And from there, you can see the market kept on dishing out break of structures to the downside. It started creating new lows. We have break of structure to the downside. We also have this tiny break of structure here to the downside, just like this. It started creating new lows. We also have this. This is a break of structure. So let me clone this to make it fast. Now this is also a break of structure here. This is also a break of structure. Let me extend this one well. then this is a break of structure here. So you can see the price is creating new lows, lower lows, higher low, lower lows, just like that. This has shown that the market is bearish. So what should we be looking out for? How to keep selling this particular currency. That's just what you should be looking at, how to keep selling. So if you take entries from the daily time frame, what you'll be looking out for is the last break of structure. Where is the origin? Now, this being the origin, you map it out. You map it out, and then you have to wait for price to get there for it to drop again. So your speculation will be for price to push up until it gets here. You want price to push up until it gets here. Then once it gets here, you want it to drop again. So that's going to be your speculation, and that is how you make money. So you can catch the push up and also catch the push down. So what this means, a trend or a direction that is moving according to trend, that is called the impulsive movement. Now the one that is going against the trend is called the correctional move. So for this type of setup now, since we want to sell once the market gets here, for the market to get here, there must be a buy. So the buy, which is going against the trend because the trend is bearish, the buy is what is called the correctional movement. So you can catch the correctional movement and also catch the impulsive move. So if you speculate that price should come here and it goes there, if you execute the trade, you will make money. And if it comes here and you're speculating that it should drop from here and it drops, you will make money. But in a situation where you speculate that it will get here, drop, and maybe it gets here and continues to push up, you're going to lose money. So that is literally trading. That is the simple strategy. I also have a video that explained my strategy clearly, so that you will go there, watch it. All these concepts, I explain them one after the other, so you can watch the video there to understand my strategy clearly. So that is how you can easily speculate the next action the market is about to take. With this strategy, you will have a clue of the next thing the market is about to do, and you take advantage of it. That is just how we literally make money. Once you understand the trading basics, you can just get a strategy that works for you and then go into trading. And it's also important for you to learn to accept the reality of trading, because once you accept the reality of trading, that is you having the trader's mindset, knowing that as a trader you have to be ready for both sides, knowing that whenever you're taking trades, you are planning for what you are willing to sacrifice and you're planning for what you are willing to get. So have it in mind that you are just a mere speculator, and if the market does not go according to your speculation, you are going to lose money. But if it goes according to your speculation, you are going to make money. That is literally trading. So my number is going to be in the description. If you have questions, I also have my private mentorship group where you can join and get a straightforward class on this, where I will give you a closer watch on how to actually understand forex trading. So just check the number in my description. You can message me, ask your questions, and also how to get access to the private class. Thanks for watching, and don't forget to subscribe and turn on the notification bell.